Hello everyone, welcome back. We will now look at couple of important topics of ACCA corporation tax, P6 corporation tax. One of which is the one which I have listed on the board. It is the scenario where the company buys back its own shares. Now sometimes what happens is that company issue the shares first, so the company is issuing shares to different shareholders. Now after issuing the shareholders, the shareholder will keep the shares for some period of time. Then after some period of time, if some of the shareholders are disturbing us, or there are some other reasons as well, so because of them reason, the company buys back shares from them shareholders. Now if the company buys back the shares of its own, then what would be the treatment? There could be two treatments. So one is called income approach, if we treat it as income, and other one is called a capital approach, if we treat it as a capital. Now what would happen if we treat it as income? So if we treat it as income, there will be income tax. So we'll take the sales proceeds, so whatever the sales proceeds are, which in most likely cases it will be more than what they have paid for us, what they have paid us in the company. So sales proceeds, and we'll deduct the original subscription price, so whatever the price they have paid us, so we'll have to deduct that out of it, and then the net amount is going to be net distribution, so the net dividend, right? So what happens is that they have sold us the shares which they bought from us. So basically, although we are buying the shares from them, but it is exactly the same thing like giving the dividend, because they are selling our shares to ourselves more than what they paid us. So if I give the dividend to other shareholders, or I do like that, it is exactly the same thing. As far as HMRC is concerned, they think like it is the same thing. So that's why it will be considered as net dividend. So, and if it is net dividend, so it will be taxable as well, assuming that there is no available nil rate band for dividend income, right? So if there is no nil rate band available for dividends, then it will be taxable according to the tax rates. Now there will be capital gains tax as well if we choose the income approach. So there will be capital gains tax as well on that. In capital gains tax, we'll take the original subscription price as sales, and then we'll deduct the cost, whatever they paid us, and we'll have to deduct that cost, and the net amount is going to be our either capital gains or the capital gains or the capital loss. Now you might be thinking that original subscription price is the amount which we have paid, and what is this cost? It is exactly the same thing. Sometimes what happens that I have bought the shares, so I have bought the shares from direct from the company, so I paid the original subscription price. But when I sell the shares to you, say for example, then I'm not selling at the original subscription price, but I am selling at after keeping some of my profit as well. So that is the cost which you are getting at, and this will be the original subscription price. Right, so that's how it works. So if you do not buy from company, you buy for someone else, so that will be cost will be different from original subscription price. All right, so it could be less than that as well, or it could be more than that. So it will be either capital gains or capital loss. Most likely it will be capital loss. All right, so that is our income approach. If we treat it as capital, there will be only capital gains tax in this section, and it will be calculated in the normal way. We'll take the sales and we deduct the cost, and it will be either capital gain or the capital loss. Right, now I'll share the screen with you so that we can read our notes, and we'll do a question on it as well, which is our past exam paper. One second. If you come to page number 83 of your lecture notes, the purchase of a company of its own shares. Right, so income approach. If a company buys its own shares more than the amount originally subscribed, general tax rules state that there is a distribution of the excess. A recipient of such distribution are treated in the same way as recipients of ordinary dividends for income tax. The shareholder will also pay capital gains tax on the shares sold to the company. However, we'll take the original subscription price as sales proceeds, as I shown you on the board. Right, a capital treatment. However, a capital gains tax disposal automatically occurs rather than income distribution when an unquoted trading company buys back its own shares in order to benefit its trade, right? So when an unquoted company buys back its own shares to benefit its trade, then it will be automatically capital treatment will apply. How would we know if it is benefiting its trade? So the list below tells us. The benefit to trade test will be satisfied where a dissident and disruptive shareholder is bought out, so the shareholder which was disturbing not only us but other shareholders as well. So it was not good to continue with him. That's why we have bought back shares from him. A proprietor wishes to retire to make way for new management. Outside investor who provided equity wishes to withdraw his investment. Shareholder dies and their PR do not wish to retain his shares. Right? Now these were the benefit to trade test. An examiner might ask you what is the benefit to trade test, then you will have to write down the things which I have just told you. On next page, if you see, these are the conditions which must be satisfied by the vendor shareholder. So whoever is the shareholder of whom you are buying the shares, so these are the conditions for him to be satisfied. Now, he must be resident and ordinary resident in the UK. Share must have been owned by himself or the spouse throughout the 5 years preceding the purchase. If one of the spouse dies, then the ownership period should be 3 years instead of 5 years. All right. So if I hold some shares and then I transfer to my wife, so my ownership period will be added in hers. So altogether, it needs to be 5 years. However, if one of the spouse dies, then the ownership period will be reduced to 3 years. Then it says vendor and her spouse must be, as a result of the purchase, have their interest in the company reduced to 75%. So whatever their shareholding before buyback shares was, so after that it must be 75% of that. So it will be reduced to 75% of what it was before. And then it says a vendor must hold no more than 30% of the ordinary share capital of that. All right, so it should be the interest in the company should be less than 30% after that. The capital gain disposal also occurs where a company purchases shares to enable the vendor to pay any inheritance tax choosing the death, and then these conditions won't apply. The benefit to trade and the vendor shareholder condition, these won't need to be applied. When the company is buying back shares from the shareholder so that they can pay the inheritance tax, only then these conditions won't apply. All right. So it was our company buy back its own shares. Now out of that, capital treatment is very, very important. These benefits to trade test, these are very important, and these conditions are very, very important as far as exam is concerned. We'll do a question in a minute, then I will show you this thing as well. Another topic which we are going to do in this lesson, in this lecture, is closed companies. Now, in one of the previous videos, this word closed company came many times in our lectures, be it income tax or other capital gains tax stuff as well. Now I told you that closed company is a company which is owned by the close family members, to be short at that time. All right. So now we will see in detail what actually is a closed company. Right then, give me 1 second. Yep. Broadly, a closed company is one that is under the control of either 5 or fewer shareholders or any number of its directors. Right. So if a company is owned by 5 or fewer shareholders or any number of directors, then it will be called a closed company. Shareholders and shareholder directors are known as participators, and direct relative of the partners are known as associates. Now, when a closed company makes a loan to one of the participators or an associate, so if the closed company makes a loan to one of the participators or associates, then because it is making the loan, the company will have to pay to HMRC a penalty, 32.5% of the amount of the loan. All right. Now, this penalty will be paid to HMRC by the company. However, this loan was given to a shareholder, right? Now, if the shareholder gives back the loan, if the shareholder pays back the loan, then HMRC will pay back the penalty which you have paid to HMRC, right? So HMRC will pay you back. However, if the shareholder does not give it back, then what the company have to do, they will write off from the accounts. Even if they write off from the accounts, they say, the shareholder took the money, then as well, HMRC will pay you back whatever you have paid in penalty, 32.5% of the loan. All right. So when a closed company makes a loan to one of its participators or associates, it must make a tax payment to HMRC equal to 32.5% of the loan. If the loan is repaid by the participator to the company, or the company writes off all of the part of the loan, then the company can reclaim all of the corresponding part of the tax charge paid over to HMRC. Now, sometimes it can happen like this as well. The shareholder took a loan of £100,000. Then I have paid, as a company, I have paid 32.5% to HMRC of 32.5% of the £100,000. Right? Now, the shareholder did not pay me all of the loan. They only paid me half of that, £50,000. Then HMRC will pay me 50% of the penalty back to me, right? So like that. So whatever the amount that a shareholder is giving back to the company, paying back the loan, so according to that amount, the penalty which you have paid to HMRC will be paid back to you, right? Right, then after that it says if the loan later is written off, then the amount of the loan written off is treated as participator's net dividend. Now, if the company is obviously, it is so obvious, I've already told you anyway. So if the company has written off the amount, then it will be considered as a dividend, and it will be taxed accordingly. Right? Now, benefits, if the car or a laptop or anything like that given by a closed company to a participator and their associates who does not work for the company are treated as receiving dividends from the company. The amount of deemed dividend is the amount calculated on the normal benefit rules. Now, if the company is giving any benefit to the participator or the associates, individuals who do not work for the company, then it will be considered as net dividend, right? So whatever the amount of benefit is, say for example a car is given, then the benefit on the car will be calculated in the normal way like we do in our income tax. So we'll calculate the benefit, and that will be considered as giving the dividend to the individual, right? And it will be taxed accordingly. So if it is under the nil rate band, it will be taxed accordingly. If it is under the nil rate band, then there won't be any tax. However, if it exceeds the dividend nil rate band, then it will be taxed accordingly, right? So it was a closed company, right? Now we will do a question on closed company and company buys back its own shares. Right, then we will do a question now, and this is question number 30 of the BPP exam kit, which was examined in 2010, December 2010. And the question name is Trifles Limited. If you have any other exam kit, please make sure you find this question, Trifles Limited, and come to this question, please. Alright, so let's go to the requirement section without wasting any time. So in the requirement number 8, it says explain whether or not Victoria and or Melba satisfy the conditions relating to period of ownership and a reduction in the level of shareholding such that the amount received from Trifles Limited on purchase of own shares may be treated as capital. Now there are two treatments, as I said. There are two treatments. One is income treatment, and the other one is a capital treatment. Now it says that there are certain conditions which the vendor shareholder must satisfy. Now it says that tell me that whether Victoria, which must be a shareholder, and Melba satisfy them conditions for capital treatment or not. Now if they satisfy the condition, then capital treatment will apply. If they do not satisfy the conditions, then capital treatment will not apply. Right, now we'll have to read the scenario. So and another thing as well, it says the conditions relating to period of ownership, right? Now the period of ownership, we know what are the conditions about the period of ownership. A period of ownership must be 5 years, including the spouse, and if one of the spouses died, then the period is reduced to 3 years, and the period of spouses can also be added into it. All right. So if it is normal is 5 years, and reduced one is 3 years if one of the spouses died. And another thing is a reduction in the level of shareholding. Now we know that reduction in level of shareholding, the shareholding must not be more than 30% after the buyback of the shares, and the shareholding must be reduced to 75% of what it was before. Right. So there are two conditions which we have studied from our notes. Now these needs to be satisfied as well. Right then, so let's read the question. Trifles Limited is an unquoted company specializing in the delivery of small high-value items, was incorporated and began trading on 1st of February 2010. This is a key date, so the company was incorporated in 1st of February 2010. Prepare accounts to 31st of March each year, has taxable trading profit not exceeding £500,000 each year, has an issued share capital of £10,000 shares subscribed for at £2 per share. Now the share capital is 10,000 shares. That is key information as well, because we'll have to see this when we are deciding reduction in the level of ownership and reduction in the level of shareholding. Right, has 4 unrelated shareholders, T, B, V and M, intend to purchase some of its own shares from Victoria and Melba. Right, so the company is buying back shares from Victoria and Melba. Then it says Victoria and Melba have been directors of the company since they acquired the shares, but will resign immediately after the purchase of their shares. T is not a director or the employee of Trifle Limited. Then it says purchase of Trifle Limited own shares. It will take place on 28th of February 2018, right, for Victoria's shares, and on 31st of March 2018, 1 month after that, almost 1 month, for Melba's shares at an agreed price of £30 each. £30 per share. Will consist of purchase all of the shares of Victoria and 450 shares from Melba, right? So 450 shares from Melba and all the shares from Victoria. So we'll read the requirement of Victoria first. Two things we need to consider. One thing is level of ownership, a reduction in the level of ownership, and other one is minimum ownership period. Right, so we'll see Victoria first. And there are 4 marks, I think, for this one. 6 marks. Right then, Victoria. Where it is. Victoria is resident in the UK, has taxable income of £40,000, including dividend income of £6,000 in 17-18. Will make no other capital disposal in the tax year 17-18. Has a capital loss carried forward as at 5th of April 2017 of 3,300. Will have no link with Trifle Limited following the purchase of her shares, because all of the shares are being sold anyway, so there will be no relation with the company after these shares. Inherited her holding of 1,500 shares on the death of her husband, and now the husband is died. It means the ownership period will be reduced to 3 years. All right, including, and we can include the husbands as well. On 1st of February 2016, Blowney paid 16,500 for the shares on 1 February 2014. So our husband bought the shares on 1st of February 2014. So we will start the period from then. It is 2014, and the shares are being bought on 2018. So these are almost 4 years. So minimum ownership period condition is satisfied for Victoria, because her husband is died, so the normal minimum ownership period of 5 years won't apply. A reduced period of ownership will apply, which is 3 years, because her husband is died. All right. And another thing is that in them 3 years we can include the period of ownership by her husband as well. Right. So if we include both of them, it is 4 years. So the minimum ownership period of 3 years is satisfied. Another condition was that reduction in the level of ownership. Now we need to see that as well. Now we know that she's selling all of her shares. Yeah, she's selling all of her shares. So we know that reduction in the level of ownership condition is also satisfied anyway. Alright, so we don't need to read that for this one. Next one is Melba. So for Melba as well, we need to satisfy these conditions for minimum ownership period and reduction in the level of ownership. So Melba is resident in the UK, has taxable income of £40,000 including dividend income of £6,000, acquired her holding of 1700 ordinary shares when Trifle Limited was incorporated. Now we'll have to see when it was incorporated. We've already seen anyway. It was incorporated in 2010, right? So this company was incorporated in 2010 and the shares are being sold in 2018. So minimum ownership of 5 years is this condition is satisfied because it has been owned more than 5 years. Now another condition is regarding reduction in the level of ownership, right? So that's what we need to figure out now. So let's see. Acquired 1700 of the ordinary shares with Trifle Limited when it was incorporated. Following the purchase of her shares in Melba, following the purchase of her shares, Melba's only link with Trifle Limited will be her remaining ordinary shares and the use of motorbike. Now we know that only 450 shares from Melba are being bought back, so she will have some shares in the company after that, right? So right then, now we'll have to see the reduction in the level of ownership. Now it is a little bit complicated one because we know that first the company bought the shares from Victoria. Now the company had 10,000 shares. When the company is buying back shares from Victoria, so it means that the company is taking its own shares, right? Now the shareholding, shareholding of the company, issued share capital will be reduced. Now you might be thinking that the company is buying more shares, so the shareholding will increase, share capital will increase. It won't increase because the share capital basically are the shares which are issued to the shareholders, right? Now when the company is buying the shares from the shareholder, now its share capital will be reduced. Now the share capital was 10,000 shares before buying the shares from Victoria. Now all of the shares from Victoria had been bought back, so the Victoria's shares were how many? 1500 shares. Now Victoria's shares were 1500 shares, so 10,000 minus 1500, 8500 shares. Now after buying the shares of Victoria, now the company's share capital is 8500 shares. All right. Another interesting thing in the question is that the company bought the shares from Victoria first, then after 1 month the company bought the shares from Melba, whatever the shares were. All right. Now we'll have to see that when the Melba is selling the shares, so the percentage in the percentage shareholding in the company will be a little different than it was in the start of the trade. All right. Now I'll just cancel the share screen. I hope that you have got the question so that we can do it on the board together. Let me erase this first. Then we will do the question on the board together. All right. Please make sure you have the BPP exam kit in front of you because I will be just cancelling the shared screen in a minute so that we can do the question on the board together. Right. So let's cancel the shared screen. Right then, so share capital at the start was 10,000 shares. If you see in the question, so that was share capital at the start of when the company was incorporated, right? 10,000 shares. Now 10,000 shares, and out of that 1500 shares are bought back from Victoria, right? Now these are the shares which were bought back from the Victoria. When the company bought back the shares from Victoria, issued share capital will be reduced to 8500 shares because these are the shares in the market now. These are the shares with the shareholders. Now whatever the shareholder are with the share, whatever the shares are with the shareholders, them are the shares which are called share capital. So this is a share capital now. All right. Now after that, now the company will buy back shares from Melba. Right. Now this is share capital. Now see that how much is the percentage in the company does Melba have. Now Melba had how many shares? Let's see in the question. Melba had 1700 shares. So we'll have to see how much is the percentage. So 1700 shares divided by 8500. So this is the percentage of shares in the company of Melba, right? Let me grab my calculator. So 1700 divided by 8500 divided by 8500. So it is 20%. 0.2, which is 20%. So I'll have to multiply it by 100. So it is 20%. Now Melba owns 20% in this company, right? However, the condition says that her interest must be reduced by 75%. So we'll have to take 75% of that. So whatever the 75% of that is, condition will only be satisfied if her shareholding in the company after buyback shares from the Melba will be 15%, it says. Right? So the condition says that shareholding in the company must be reduced by reduced to 75%. So the condition will only be satisfied if her shareholding, Melba's shareholding in the company after buyback shares is 15%. Right? Now see how much actual percentage she has got in the company. Right? So how many shares have been bought back? Let's see from Melba. Melba's shares. Maybe 1 second. Todd, motorcycle, Melba. And 1700 shares. Where does it say? Victoria. Yeah, the purchase of trifles of its own shares, and for Victoria, all of the shares of Victoria, and 450 shares from Melba. So 450 shares are being bought from Melba. So let's see. After the purchase, it is going to be 10,000 was the initial, then 1500 was bought back from Victoria, another 450 from Melba. Remaining are how much? How many? 10,000 less 1500 less 450, 8,050. These are the remaining shares in the company. This is the remaining share capital of the company, right? Now how many shares does Melba have now? Melba had 1700 shares. Out of that, 450 are bought back. Remaining shares are 1700 less 450. 1250 shares are remaining in the company by Melba. Now let's see the percentage in the company. So it is 1250 shares in the company now, out of total of 8050 multiplied by obviously 100. So 1250. Now if it is less than 15%, that's fine. If it is more than 15%, then the condition is not satisfied. So 1250 less 8050 multiplied by 100, it is 15.527. so it is more than 15%. basically you can just write down 15.527. so it is more than 50%, more than 15%. so the condition is not satisfied for reduction in the level of shareholding. However, the condition for minimum ownership period is satisfied, but the condition for reduction in the level of capital for Melba is not satisfied. All right? So we have answered this requirement as well. Now please make sure I've done the calculation bit here. While you are doing this thing, you will have to write down like a commentary. You are writing down an essay. Only then you will be able to seek your marks, because that's very, very important for P6. Please make sure you write down like you are writing an essay. So in part A, we have done all of the requirements for part A. In part B, it says calculate Victoria's after-tax proceeds from purchase of her shares. If the amount received is treated as capital, if the amount received is treated as income, and there are 6 marks for this one as well. All right, let's do this one now.